Welcome to the 3-Edge Week in Review for the week of July 22nd. I'm Fritz Folts, the Chief Investment Strategist here at 3-Edge. Joining me here once again today is Steve Cucchiaro, CEO, Chief Investment Officer here at 3-Edge Asset Management. And today, Steve and I will discuss the recent shakeup in the U.S. presidential election, with President Biden stepping aside and Vice President Kamala Harris moving to the top of the ticket as the Democratic nominee for president. We'll cover what it could mean for the markets with just 100 days or so before the election in November. We'll also discuss the recent rather extraordinary rotation in U.S. equities into small cap and value stocks. And sometimes the rotation is referred to as the Trump trade. And so we'll discuss how this recent rotation in U.S. equity markets could be impacted by the shift in the political landscape. In the global capital markets this week, the rise in the U.S. equity markets in the first half of the year seemed to hit a pause button here in mid-July, at least for now. Last week, the S&P and the NASDAQ both experienced their worst one-day decline since 2022. We had earnings from some of the biggest tech companies, Alphabet and Tesla, which were okay, but apparently not stellar enough to match investors' heightened expectation for these companies. And of course, investors remain hyper-focused on the Fed and when they could begin to lower short-term interest rates. The FOMC meets next week, actually, and there's some agreement that they could begin to lower rates in September. However, there are some on Wall Street who believe the Fed has already waited too long to cut rates, and they should actually do that next week at the FOMC meeting. So, Steve, we know investors are more anxious now with this dramatic, change in the presidential election here in the U.S. and what it could mean for the markets heading into November. So perhaps you could just help to level set and describe how President Biden's announcement that he will not seek a second term could affect the markets and discuss the so-called Trump trade.
Well, I'll begin with the Trump trade. The basic idea behind the Trump trade is that Trump and Vance favor deregulation, they favor a pro-growth tax policy, and they favor tariffs. And when you put all that together, all else being equal, that tends to favor domestic-oriented manufacturing companies, regional banks, energy companies, and these all fall in the small cap area. And where small caps have so underperformed for so many months, in fact, years, against the large caps, we saw a major reversal. And a lot of people are attributing that to the so-called Trump trade. In fact, over the last couple of weeks or so, the several indices of high-tech stocks were down nearly 10%, while certain indices of small-cap stocks were up nearly 10% in the same time frame. That's really quite unusual and extraordinary. Part of that is that before Biden dropped out, the market placed higher odds on Trump winning, and so the Trump trade was taking a life of its own. Now with him stepping aside, of course, there's more uncertainty whether that will continue.
Excellent. All right, so let's dig a bit further into this, the Trump trade, if you will, and because it's important to realize that it wasn't just the Trump trade, though, right? There are other factors at play here that may have caused the rotation in equities.
In my opinion, the prospect for change in Fed policy is even more important to this great rotation than the idea of a Trump trade. When we envision higher for longer interest rates, all else being equal, that tends to favor large cap companies. In fact, the large cap growth companies like the big tech companies that generate so much cash on their own, they don't need to borrow in the markets. They don't care what interest rates are so much, except for maybe their customers. They can withstand a slower economy because they generate their own growth. Whereas the prospect of the Fed, after waiting a very long time, finally cutting rates, is music to the ears of the smaller companies who do have to go out and borrow in the market, who are much more sensitive to the economic cycle, much more sensitive to the interest rate cycle, and can really benefit from some relief from the Fed. So I think the prospect of a change in Fed policy is even more important to this idea of a rotation. Also, I would say that last time, maybe not the last time, but one time that was really prominent in my thinking, when we had a rotation like this, it was in the year 2000. And we should all remember that the year 2000 was the year that the famous internet tech stock bubble burst. And so we do have to think of this as a potential warning sign that maybe not only are we getting a shift in leadership, but maybe this is an early warning sign that the market is about to correct its overvaluation.
All right. So my final question is, after what we've discussed here today, and with the additional uncertainty of the U.S. president election now, and what might investors consider doing in their own portfolios now that we're just about 100 days out from the November election?
Well, the optimists are hoping that we get a combination of events where the Fed does cut rates sooner than later, that they do it in time to preempt a recession, that they do it in a way that inflation doesn't rebound, and we get this perfect Goldilocks, so-called Goldilocks economy, where the economy is growing but not so strong to cause inflation, not so weak to cause unemployment to go up or a recession. Everything is perfect, and the economy and the markets continue to go. However, it would be important to point out that this is very rare in history, that the Fed cuts and we get a Goldilocks environment. And before almost every rate cut cycle, the market talks about soft landings, they talk about Goldilocks, but it almost never happens. It's certainly possible. What usually happens is by the time the Fed cuts rates, because they're often data dependent, the data is lagged, they cut rates too late, and then there's an additional lag between monetary policy and when it works its way through the economy. So with all those delays and lags, the first rate cut usually is when a recession or a major slowdown begins. And it's usually not good news for the stock market. And in fact, the stock market continues to do poorly until the so-called last rate cut. That's the more typical experience in history. This could be an exception. The optimists are certainly hoping for that. But I do want to point out, too, going back to the election, some of the differing economic policies of each party. And as the election odds change between now and November, people can have in mind how certain of these policies might impact the markets. First, I'll start with the Republicans. And at the risk of oversimplifying, I'm just going to pick some highlights. But Republicans favor extending the 2017 corporate tax cut, or even producing a further cut. The Republicans favor higher tariffs. The Republicans favor lower interest rates. The Republicans favor a weaker U.S. dollar. Shifting to the Democrats. Democrats seem to favor letting the tax cut expire, which it normally would in 2025. And some have talked about tax hikes. They also have a protectionist policy like the Republicans, but a little less dependent on tariffs and more on sanctions. They favor more of an industrial policy, government spending to try to prop certain industries and help certain industries, and also more infrastructure spending, especially around energy transition, and also more discussion about entitlement spending. So those are some contrasts. But if you step back, you realize that neither the Republicans nor the Democrats are addressing the government debt problem and the deficit problem that's just getting worse by the day. And in very different pathways, both the Republican and the Democrat economic policies could be argued as stagflationary. There are certain elements in each that are harmful for growth, and there's certain elements of each that promote more inflation, not less. So that's something that should be kept in mind. So as an investor, I would want to make sure that I had hedges against the potential for stagflation, against the potential for the deficit getting worse. And those hedges would not be the traditional hedge that most people turn to between 1980 and 2020, which are long-term bonds. The better hedges against stagflation and rising government debt would be short-term treasuries, TIPS, and gold.
Excellent. Very good. Thank you very much for your insights into these topics. It's going to be an interesting 100 days between the Fed and the election. No doubt there'll be more twists and turns to come. So that will do it for Steve and me for this week's edition of the 3Edge Weekend Review. I will be back next week with our head of research, Eric Beagleisen, to provide our monthly 3Edge View from the Edge, where we provide our firm's most recent outlook for the global capital markets, which is based on our proprietary research model. As a reminder, all our videos are always available on our 3Edge YouTube channel. And if you know someone you think might enjoy and benefit from our weekly videos, please feel free to share them. So until next time, on behalf of Steve and everyone here at 3Edge, thanks for listening.